the biggest retailers in America, Target is the one reporting the worst performance right now, fresh data shows. Even its top executives admit that the chain has alarming problems. And those are having a disastrous impact on the retailer's bottom line. Target has dealt with an unprecedented 90% drop in profits in the past year. But its strategy to raise prices in 2023 to offset these losses is hurting the retail giant way more than helping. Consumers are not interested in buying 60% of the company's inventory, and the remaining 40% is significantly more expensive this year, leading people to choose other retail shops for their everyday purchases. Target sales continue to disappoint, and investors and major financial institutions do not believe things will improve for the chain anytime soon. The ugly truth no one seems to have the guts to say is that Target is rapidly deteriorating all around us, and its downfall may happen sooner than anyone anticipated. That's what we're going to expose today. But before moving on, we kindly ask you to support our work with a thumbs up, and don't forget to subscribe to our channel so you don't miss our upcoming videos. It's been over 23 years since the last time Target experienced such a prolonged losing streak. Not even in the early 2000s, when financial markets were being hammered, the retailer reported such steep losses as the ones that happened in 2022 and 2023. Last year, the industry giant lost money in all 4 quarters, with profits dropping by 49% in quarter 1, 90% in quarter 2, 54% in quarter 3, and 52% in quarter 4. Sales at its stores and on its website slumped, despite the fact that the company was offering deep discounts to get rid of unwanted inventory. This year, conditions have become even tougher as customers cut back on discretionary spending amid a weakening broader economy. The problem is that general merchandise in categories like apparel, accessories, and home goods is the retailer's core strength, and it accounts for more than 60% of Target's inventory. In other words, on top of everything else, the company has lost 60% of its sales potential. The situation is worrying its executives, experts in the retail industry, and even Walmart's former CEO Bill Simon, who said during an interview with CNBC that retailers like Target are in huge trouble as recessionary trends are likely to be sticky in the discretionary category. Those stores will have to differentiate themselves and have an offering of product or service that is in demand. Those without as much food will struggle to keep up, Simon said, referring to retail chains which typically sell more non-essential items than staples. Just a few months ago, Target EVP and Chief Growth Officer Christina Hennington noted that the cost of housing, energy, and food are absorbing more of American spending than ever before, and unfortunately, the chain was not well positioned in terms of inventory when this crisis began. When consumers direct a larger share of their budget to groceries, sales in home, apparel, sporting goods, and electronics categories, which represent nearly 2/3 of Target's merchandise, were all down between 7% and 9% digits compared to the same period last year, according to Hennington. We see our guests holding out for and expecting promotions more than ever, spending less on regularly priced items, she revealed. Even though the remaining share of its product offering, or about 39%, is in the grocery category, the company didn't see any significant increase in grocery sales in 2023 either. In fact, after rising by a mere 1.7% and 0.8% in January and February respectively, grocery sales declined by 0.7% in March and 0.9% in April, generating a dismal 0.9% uptick in food sales for the entire quarter. That's because the retail giant may have made a terrible mistake in its pricing strategy. Given that its discretionary items are now selling at discounted prices due to an oversupply of goods, the company decided to introduce new price increases in the only category where it remained profitable. But customers did not take the price changes lightly. In a year span, Target's overall grocery prices rose by a staggering 21%, according to data provided by Go Banking Rates. By comparison, Walmart rose its food prices by 27%. However, that increase happened in a span of 2.5 years, and Walmart's prices were lower than Target's in the first place, so its competitor actually had room to do so, while Target may have pushed their customers far too much. Prior to that, the company had already passed along higher operational costs to consumers in 2021 and 2022. On a Reddit thread where shoppers discuss price hikes at Target stores, one of them says that prices at the retailer stores have become insane. I know inflation is the excuse given, and there are many other issues in the mix of price increases, but I knew it got bad when I couldn't afford my basic purchases from a year ago. I saw that watermelon came back and the price was $9.99. On some occasions, these would go for $3.99 during promotions and wouldn't be more than $4.99, the person shared. The chain's grocery prices are not as affordable as their competitors. Costco, Aldi, and Walmart can offer more value and better deals for their customers. Another problem often mentioned by Target shoppers is that there are always empty shelves in the grocery section. The quality of fruits and vegetables is questionable, and some products disappear and never come back to the stores. The decision to raise its food prices again came at the worst possible time, just as other retailers are doing their best to keep inflation tamed to attract more consumers and boost their profit margins. And instead of focusing on the needs of its current customer base, Target is aiming higher. The industry titan is now actively trying to attract more households earning over $150,000 a year. In 2019, only 14.8% of its customers were upper middle-class households. Today, that share rose to 19.6%. Although these customers tend to spend more, generating a bigger ticket per sale than lower middle-class and low-income families, they are not numerous enough to help fix Target's financial problems. At the end of the day, Target is a mass retailer that is supposed to court consumers of all incomes. At times, the retailer seems to forget this. The most glaring example was its ill-fated holiday partnership with luxury department chain Neiman Marcus. The collection flopped, mostly because Target priced the merchandise too high, and the fact that it is still doing a lousy job with reliably supplying its stores with food and groceries, the non-discretionary categories that drive repeat traffic because consumers always need to replenish their kitchens and pantries, indicates that the company isn't taking the necessary actions to dig itself out of the hole it is in right now. Even the company's CEO and chairman, Brian Cornell, has admitted that their customers are hurting from the price increases of 2023. We've had a consumer who has been dealing with very stubborn inflation for quarter after quarter now. They're shopping very carefully on a budget, he said. With high rates of inflation contouring the road and their purchasing power, many consumers this year have relied on borrowing or dipping into their savings to manage their weekly budgets. But for many consumers, these options are starting to run out, Cornell noted. Consequently, our guests are exhibiting increasing price sensitivity, becoming more focused on and responsive to promotions, and more hesitant to purchase at full price. CFO Michael Fidelke said during an earnings call that today, even as the pandemic feels further and further behind us, we continue to face elevated macro uncertainty and volatility as the world continues to transition toward a new normal. At the moment, if the company wants to stay on the upper end of its already modest sales forecast for 2023, it needs to boost sales in the back-to-school and holiday shopping season. But investors and financial institutions alike do not believe the retailer will be able to deliver better results. After posting weaker than expected first quarter results, JP Morgan downgraded Target stock due to its high exposure to further financial losses in the second half of 2023. That sparked a massive sell-off that made Target's share halve in value since its peak, according to MarketWatch's data. We continue to believe that the consumer is broadly weakening while the share of wallet shift away from goods, which represent the highest share of Target sales, is ongoing, wrote JP Morgan analyst Christopher Horvers. We believe this share loss could accelerate into back to school and linger into holiday, given consumer pressures and recent company controversies. This could turn Target's traffic negative, he added. The company was already losing market share, and we fear that these headwinds might not abate in the second half. To add insult to injury, this year's CEO Brian Cornell predicts that organized retail crime would fuel as much as $500 million increase in stolen and lost merchandise, bringing the total loss, called shrink in the retail industry, to well over $1 billion. In addition, like the rest of the industry, we're facing a growing financial headwind from inventory shrinkage, which is running hundreds of millions of dollars higher than a year ago. Along with other retailers, we've seen a significant increase in theft and organized retail crime across our business, he stressed. Target's total shrink was around $400 million in fiscal year 2021 and rose to $736 million in 2022. If the anticipated $500 million increase does materialize in 2023, that would bring the three-year total to a whopping $2.4 billion. That's a huge sum, and it's no joke for Target's financials either. That hit comes directly out of the company's bottom line, so it should come as no surprise if the chain announces more store closings in the months ahead. So far in 2023, the retailer has closed 49 stores across Maryland, Virginia, Minnesota, and Pennsylvania due to the rise in the number of cases of stolen merchandise in the past couple of years. At this point, financial analysts are concerned that the company's downfall may occur sooner than anyone expected. Douglas A. McIntyre, the co-founder, chief executive officer, and editor-in-chief of 24/7 Wall Street, noted in a recent analysis that Target has become the worst performing retailer in America this year. It may appear that a comparison of retailer Target to smaller companies in the sector is ridiculous because they include crippled Bed Bath & Beyond and faltering consumer electronics brick-and-mortar operation Best Buy. However, Target is so large and has a sophisticated operation that it should do much better than these third-tier companies. It has not, McIntyre emphasized. Target's most recent quarterly figures show that comparable store sales in the first 2 months of quarter two were 4 times lower than in the same period last year. All financial figures remain well below expectations. In the past year, Target has essentially made no money at all. Management said revenue growth for its 2023 fiscal year would be in the low to mid-single-digit range, which was another shocking disappointment. The company seems to be crumbling from within, and if it fails to address its problems with efficiency, it may break apart right before us, just as many other retail giants did before they disappeared forever. That would be an unfortunate ending for such a popular retailer. But this industry is ruthless, and competitors are stepping up their game, while Target continues to deteriorate all around us.